So one of the major problems with business owners getting into any kind of M&A transaction is they don't understand the true value of their business. What I'm going to do in this next minute or minute and a half is I'm going to explain to you in very basic terms the way that most businesses are valued. We all hear about the outliers, how Bobby or Susie sold their business for $30 million. You go, well, wait a minute. Nobody wants to buy my business for $30 million, but my business is just like Bobby's or Susie. Why not? What's going on? Chances are you haven't heard about the 10 other businesses just like yours that sold for $5 million. And what you want to do is set your expectations at the right level, because ultimately the only way you're going to be happy is if your expectations are met in an M&A type transaction. So let's think about how to set values properly, what a detractor is from value, and how you add to that value. First and foremost, let me tell you that 90% of the businesses out there sell between 3 and 7 times earnings. If you're growing real fast and you have a super stable business, you might be at that 7 times earnings range. If you're relatively flat and you have a little bit of a volatile business, you might be at that 3 times earnings range. But nearly every business on the planet sells somewhere between 3 and 7 times earnings. We're talking here about private companies. The way you know this is because big giant public companies that are much more stable, much less risky, are trading at somewhere between 12 and 20 times earnings. Just about double or triple what we're saying in the small business arena, where that failure rate is a lot higher and the risk is higher. Now this is a really interesting pivot point, because we were just talking about risk and why a public company is worth more than a private company. So how do you as a private company start to de-risk your business? There are a handful of things you can do, and I'm going to come up with 5 right now. First and foremost, accurate accounting. I know I sound like a broken record, but when you look at something and you see that the numbers don't add up to the story and these don't match and something's wrong, you're immediately going to think higher risk, I don't believe these guys, value goes down. Number 2, think about customer concentration. Do I have one customer making up 30% or more of my revenue? If so, risk goes up, value goes down. Third, think about the way you interact with your customers. Are you a recurring revenue business, or are you a one hit and then you got to go find a new customer? And what are the processes that you know to make your business more and more predictable? Because the more predictable a business is, the less risk it is, the higher value it has. Fourth, what I want you to think about here is your selling process. Everybody's going to want to know, can they replicate the business that you've got? If you have a process that shows exactly how you go from step 1, 2, 3, and 4 in selling your business, or in selling your product or service, your business is going to be more predictable, therefore more stable, therefore more valuable. And finally, think about your financial management. How are you managing the business? Does it have ample cash to meet its demands, or is it right on the brink of failure all the time and you have to constantly put more cash in? The more stable a business, the less risk, the higher the value. So just a quick recap. Businesses are going to trade between 3 and 7 times earnings, 90% of them, but that's a huge gap. Use those 5 things to improve your business value and decrease the risk.